I'm Bob Fragasso, Fragasso Financial Advisors. There is a proposed set of law changes, both income and estate tax, that will upend investment and tax planning for our clients and us and you, the listeners. Fragasso Financial Advisors are not tax attorneys nor CPAs. The information contained in this video should not be construed as tax advice. One should speak with their tax professional for tax advice, guidance regarding their personal situation. Now, our guest today is an attorney, so he speaks with authority, but once again, tax guidance should be individualized and you should put together your own board of directors on a per client basis, attorney, accountant, and yourself as a financial practitioner. As investment practitioners, we have the opportunity of leading our clients toward a proactive set of actions that will both better their situation and provide a larger body of liquid investment assets that can benefit from our investment management. We're fortunate today to have a good friend and expert practitioner, Jim Carlisle. Jim is a corporate attorney specializing in the transition of illiquid assets, businesses, real estate, and specialized assets into a liquid form. Welcome, Jim. Tell us a bit about your background.
So I am a partner in Dinsmore and Scholl law firm, and Dinsmore is a national law firm with about 800 lawyers in 27 offices. And I've been practicing law for 31 years, handling domestic and international merger and acquisition transactions and growth and exit planning projects. And over that time, I've handled hundreds of transactions, whether they be mergers and acquisitions or growth and exit planning projects. I'm chair of Dinsmore's National Growth and Exit Planning Practice Group. And I'm also working with clients these days. I think my highest value is being an architect and a designer of customized growth and exit plans for our clients.
Jim, the current tax proposals are not yet law. Why should we pay attention to what's being discussed now versus awaiting enactment?
So Bob, 2021 has been a momentous year, and keeping track of the four major tax reform proposals is a heavy lift. And so whether you're a financial advisor, a life insurance agent, a CPA, or an attorney, you need to be able to advise your clients as to the best course of action for the time remaining in 2021 and into 2022. So even though these proposals have not yet been enacted, it's essential to be looking ahead to the future so that you can plan your next steps and your clients' next steps accordingly. Under President Biden's proposed plans, tax rates are anticipated to significantly increase, including individual, corporate, capital gains, and estate tax rates. By being proactive with regard to these proposals, business owners have the opportunity to save a lot of money that could be lost to taxes if these proposals are implemented. It takes time to plan as to what assets you might want to transfer or what actions you may want to take. So if people wait until these proposals are enacted, it may be too late to take action. And that's why we're advising our clients to look ahead to what's being proposed and to be ready so that when it's enacted, they already have actions pending.
Procrastination limits the clients and our range of choices and may cost money. So I understand that. Well, what are these proposals and how might they impact our clients? We don't know for sure, but as we see it today, what opportunities do they offer us and to our clients?
So the key points of President Biden's American Family Tax Plan are these. The highest individual income tax rate is going to increase from 37% to 39.6%. The corporate tax rate is going to increase from 21% to 28%. Capital gains tax rates are going to increase from 20% to 39.6%. And when you add in the Medicare surtax increase, the rate jumps to 43.4%. So those changes will apply to taxpayers whose annual income is in excess of $1 million and where investments account for more than 40% of their income. There's also going to be an elimination of the step-up in basis at death for gains of more than $1 million for individuals or $2.5 million for married couples. Appreciation of unsold assets or unrealized gains it's proposed to have those be subject to capital gains tax. In the estate tax arena, the current federal estate tax exemption is $11.7 million, and it's proposed to be changed to $3.5 million with a new proposed progressive tax system for estates transferred at death. So the tax rate of 45% would apply to estates that are 3.5 million to 10 million. 50% would apply to 10 million to 50 million. 55% would apply to 50 million to 1 billion. And 65% would apply in excess of 1 billion. So due to the proposed hike in capital gains tax, among others, sellers will be paying much more in taxes in 2022 than if they would sell their businesses right now. So these proposals open up an opportunity for sellers of businesses to keep more of their purchase price if they were to sell before the effective dates of President Biden's proposed changes. And I think when you look at what happened with COVID and the epidemic, a lot of business owners were primed to sell their businesses before the epidemic hit. And so they were then put on hold. So there's a pent-up inventory of those businesses to be sold. In addition, many people's experiences through the COVID epidemic has caused people to accelerate their plans to want to sell. So there's a very large inventory of businesses now on the market to be sold. And if those businesses can be sold before the effective dates again, sellers will keep significantly more of their prices, more of their purchase price. So with the loss of the step up in basis and the increased capital gains tax rates, you're going to see many business owners motivated to take their businesses to market. And financial advisors need to work aggressively with their clients to take the right courses of action with respect to these new tax laws. And Fragasso Financial Advisors has those resources to help you maximize this unique historical opportunity with your clients.
The changes are substantial. And even if in the final enactment, it's pared back a bit, those are still major increases in all categories. So planning is certainly mandated. Jim, can you quantify the cost of procrastinating on, say, a $10 million business in a $15 million household?
On the estate tax side, if you look at a household that has a $15 million net worth outside of their business, and then they have a $10 million business, the exemption under current law is $11.7 million for husband and $11.7 million for wife, leading to a total exemption of $23.4 million. So out of the $25 million estate, with the $23.4 million exemption, that would leave a taxable estate upon the second to die of the husband and wife of $1.6 million. So if you applied an estate tax rate of 40%, you would end up with a state tax due of $640,000. Now, under the proposed law, the same household $15 million value plus a $10 million business, but now with the exemption dropping to $3.5 million per husband and wife, it leads to a total exemption of $7 million. So then the taxable estate upon the second to die of the husband and wife would be $18 million. So now the estate tax rate that's proposed to apply to an estate of that size is 50%. So So the estate tax could be $9 million. So under current law, $640,000. Under proposed law, $9 million for a difference of $8,360,000. So that's why we're urging advisors to talk to their clients about considering advanced estate planning techniques. On the income tax side, if you have a $10 million business, and for this model, we're assuming it's a Pennsylvania C Corp and that it has zero basis. So for this example, you have a $10 million business. Under current law, upon the sale of that business, the PA corporate tax rate of 9.99% would apply. The US corporate tax rate of 21% would apply. And there'd be tax of $1.89 million, leading to a liquidation amount of $7.11 million. Then, when that amount is distributed to the shareholders, there would be PA personal income tax, there'd be US federal income tax, and it would lead to a net distribution that will find its way to the shareholder of the C Corporation of $5.252 million under current law. Under Biden's proposed tax changes, the tax rate on the corporate federal rate goes from 21% to 28%. And down when the proceeds are distributed to the shareholders, the tax rate would go from 23.8% to 43.4%. So the net to the shareholders would change from 5.52 million to 3.55 million. So that difference is extreme. It's almost $1.7 million. And that would affect the ability for a business owner to retire and or their standard of living in retirement. So it's very significant.
And I guess that becomes even worse if there's a bit of a delay between the two deaths and there's growth in the assets in the meantime. Those numbers become even more startling. Well, how can an independent advisor or even one in a captive investment firm move to help his or her clients in such a situation? How do they get this process started?
I suggest that advisors reach out to their clients, raise the relevant issues, and start talking it through with them. They'll appreciate it. I would join on a call with their lawyer or their CPA to discuss the issues. This is going to show your client that you care, you're watching out for them, and that you're thinking about them. And I would also start discussing the best investment strategy that they have with the liquid funds they're going to receive when their business is sold. If you want to remain a key advisor to your client, you need to bring the important issues to them and work with them to resolve these issues, or they'll find somebody else who will. Some of the ideas that we're seeing coming out of these proposed enactments are Roth conversions, gain harvesting, deferring loss harvesting, and deferring business expenses. But these are just examples. It's case by case, but there are ideas to consider with your clients. And if you get to them and show them that you care, they'll appreciate it.
Investment advisor's process needs to include both a sophisticated and all-encompassing approach and one that's coordinated with other professionals such as yourself. So where does the advisor begin?
Just pick up the phone today and start calling your clients and start having the discussions. You can procrastinate, time will pass, somebody else will step into the void and serve as your client's most influential advisor unless you take the action. So I would suggest make up a list of your top clients and start making the calls today.
Our firm does this as well experienced in this process, even having done it in our own firm with Jim's help. Jim, if someone needs your expertise, how can they contact you?
They can call me at my office or they can reach me by email.
We are making this expertise available to other advisors, we meaning Fragasso Financial Advisors, through our Associated Advisor Initiative. where independent advisors, or those who are currently captive who wish to move to independence, can make full utilization of our resources. You can read more about that at our website for associated advisors, which is fragassopartners.com, and call me directly, direct line 412-227-3220, or email to rfragasso@fragassoadvisors.com. So I want to thank each of you for listening today. We have an imperative to do the right thing for our clients and to work as an effective board of directors to include the attorney, the CPA, and yourself. Thank you all for listening today.